Types of policies. It is often called the cash surrender value. This value is a result of the way premiums are calculated and interest is paid, as well as the policy reserves that build under this system. The amount of policy cash value depends on a variety of factors, including the face amount of the policy, the duration and amount of the policy premium payments, how long the policy has been in force. The larger the face amount of the policy, the larger the cash value. The shorter the premium payment periods is, the quicker the cash value grows. The longer the policy has been in force, the greater the buildup in cash value. The reason for these things can be classified with an understanding of maturing of whole life policy. Maturity at age 100. Whole life insurance is designed to mature at age 100. The significance of age 100 is that as actually assumption is every insurer is presumed to be dead by then. While some people live beyond the age of 100, the number of people who do live that long is not substantially significant portions of the population. Consequently, the premium rate for whole life insurance is based on the assumption that the policy owner, usually the insured, will be paying premiums for whole life to the insured age 100. At age 100, the cash value of the policy has accumulated to the point that it equals the face value amount of the policy, as it would actually be designed to do so. At that point, the policy has completely matured or endowed. No more premiums are owed. The policy is completely paid up. For those lucky insured that live to age 100, the insurance company will issue checks for the full value of their policy. Practically speaking, very few people live to age 100. It's far more likely that a whole life policy will be cashed in for the surrendered value, or that its face value will be paid out as death benefits prior to maturity. Living benefits. Another unique feature of whole life insurance is the living benefits it can provide through cash value. Accumulated buildup in the policy is a policy owner has a ready source of funds that may be borrowed at reasonable rates of interest. These funds may be used for a personal or business emergency. For example, they could be used to help pay for a child's education or pay off mortgage. It is not a requirement of the policy that the loan be repaid. However, if a loan is outstanding at the time the insurer dies, the amount of the loan plus the amount plus any interest due will be subtracted from the death benefit before it is paid. Cash value belongs to the policy owner. The insurance company cannot lay claim to these values. This concept is discussed in more detail at later under non-forfeiture values. Whole life premium. As noted, whole life is designed as if the insurer will live to age 100 according to the amount of premiums for a whole life policy is calculated in part on the basis of the numbers of years between the insured age and at issued and age 100. And the shorter the payment period, the higher the premium. This time span represents full premium paying periods for the amount of the premium spent equally over that period that is known as the level premium approach. As is the case with level premium term insurance, this approach allows whole life insurance premium to remain level rather than increase each year with the insured age. Basic forms of whole life. Just because whole life premiums are calculated as if they were paid to age 100, they do not necessarily have to be paid this way. Whole life is flexible, and a number of policy types have been developed to accumulate different premium paying periods. There are three notable forms of whole life plans are straight whole life, limited pay whole life, and single premium whole life. Straight whole life insurance provides permanent level protection with level premiums from the time the policy is issued until the insurance death or age 100. Limited pay whole life. Limited pay whole life policies have premiums that are limited to a specified number of years. This period can be any duration. For example, a 20 payment life policy is one which premiums are paid for 20 years from the policy inception, after which no more premiums are owed. A life paid up at 65 policy is one which the premiums are payable to the insured age 65, after which no more premiums are owed. This type of coverage would best suit a prospective insured who desires permanent insurance but does not want to pay premiums indefinitely. Keep in mind that even though the premium payments are limited to a certain period, the insurance protection extends until the insured death or to age 100. Single premium whole life. The most extreme form of limiting pay policy is a single premium policy. A single premium whole life policy involves a large one-time only premium payment at the beginning of the policy period. From that point, the coverage is completely paid for the full life of the policy. Here are the common traits of single premium whole life policy. An immediate non-forfeiture value is created. An immediate cash value is created. A large part of the premium is used to set up the policy's reserve. The advantage offered by a single premium policy is that the policy owner will pay less for the policy than if the premiums were stretched over several years. Premium periods. The length of the premium paying period also affects the growth of the policy's cash value. The shorter the premium paying period, and consequently the higher the premium, the quicker the cash value will grow. This is because a greater percentage of each payment is created to the policy's cash value. By the same token, the longer the premium paying period, the slower the cash value grow. Cash value builds up limited pay policy faster during the premium paying years than during non-premium paying years. After the premium paying period, the cash value continues to grow, but more slowly until the policy matures and cash value equals the face amount again at age 100. Other forms of whole life. There are many other forms of whole life insurance, most of which are characterized by some variations in which ways the premium is paid. Let's review these policies next. Modified whole life. Modified whole life policy is distinguished by premiums that are lower than typical whole life premiums during the first few years, usually 5, and then higher than typically thereafter. During the initial period, the premium rate is only slightly higher than the term insurance. Afterwards, the premium is higher than the typical whole life rate at age of issued. The purpose of modified whole life policy is to make the initial purchase of permanent insurance easier and more attractive, especially for individuals who have limited finance resources, but the promise of an improved financial position in the future. Equal index whole life. Equal index whole life insurance is a type of whole life where 80 to 90% of the premium is invested traditionally fixed incomes, securities, and reminders of premium invested in contracts tied to stipulate stock index. Graded premium whole life. Similar to modified whole life, graded premium policies also redistribute the premiums are lower than typical whole life rates during the preliminary period after the policy is issued, usually lasting 5 to 10 years. The premiums will initially increase yearly during the premature period, then remain level afterwards. Endowments. Besides term and whole life insurance, also issuance endowments policy. An endowment policy is characterized by cash value that grows at rapid pace so that the policy matures or endows a specific date that is before age 100. An endowment policy provides benefits in one of two ways: as a death benefit to a beneficiary if the insurer dies within the specified policy period known as the endowment period, as a life benefit to the policy owner if the insured is alive at the end of the endowment period at which the policy has fully matured. Because an endowment policy pays a death benefit if the insurer dies during a certain period, it can compare to level term insurance. The new concept presented here is that of pure endowment. Pure endowment insurance is a contract that guarantees a specific sum paid only if the insured is living at the end of a stated time period. Nothing is payable in the case of prior death. These two elements, level term insurance and endowment, together provide the guarantees endowment contract offer. Endowment policies can compare to whole life policies with accelerated maturity dates to age 65 is a common matured age. At the mature age, the cash value has grown to match the face amount, just like when it occurs at age 100 with a whole life policy. Because they are designed to build cash value quickly, endowment policies are typically purchased to provide living benefits for a specified future time for retirement, for example, or funding child's college education. Endowment premiums. Due to the rapid cash value buildup to provide early policy maturity, endowment policies have comparatively high premiums. Remember that the short policy term, the higher the premium. It should be noted that the purchase of endowment policies have been on the decline for several years. This is because they no longer meet the income tax definition of life insurance, and consequently they no longer qualify for the favorable tax treatment life insurance is given.